Hello and welcome to Moneylife News and Views. I am Debashis Basu. For decades, economists have complained that India is spending too much on revenue expenditure and not enough on capital expenditure or Capex. That complaint can at least be retired. In the last 11 years, the Modi government has spent close to 54 lakh crores on Capex, or about 38 lakh crore after the pandemic, that's COVID 19, when the big spending actually happened. For 3 consecutive years, public investment has exceeded 11 lakh crore annually, poured into railways, defense, roads, water, and other kinds of infrastructure. In financial year 25, capital outlays accounted for 23% of total government spending, the highest in 2 decades. Surely this would have got us big dividends, economic and non economic. Faster connectivity, lower or stable infrastructure costs, leading to higher productivity and output and competitiveness. The non economic benefits would have been cheaper and faster travel, better civic infrastructure, water and power connections. The government spending would trickle down quickly and benefit the masses with more jobs and higher wages. At least that was the theory. Above all, the state's heavy spending was expected to awaken a long dormant animal spirit, private capital expenditure. That spirit, however, remains stubbornly asleep. Successive rounds of policy making have tried to rouse it, each with the same disappointing result. The government's first diagnosis was that private investment was held back by India's festering bad loan problem. So, public sector banks, burdened with dud assets from the previous Congress led years, were too crippled to lend. In response, the government made sweeping changes. Bad loans were written off, banks were recapitalized, and a bankruptcy code was enacted, and the system was purged of its rot, though few culprits were punished. But nobody asked businessmen whether it was lack of money or poor demand which was holding them back from investing. Private capex remained weak. Next came tax cuts. In September 2019, amid flagging exports, a consumption slowdown, and a shadow banking crisis from, remember, infrastructure leasing, financial services, DHFL, and all of that, corporate income tax rates were slashed dramatically. The logic was textbook. Lower taxes would mean more money in the hands of companies and they would then invest. But again, nobody asked the obvious question: are firms being held back by high taxes or by something else, such as lower demand? The result was the same. Private capex remained weak, and then comes round three. The government went further, still believing in private sector to be the main engine for growth. All else being equal, it launched a state spending initiative, which is production linked incentive manufacturing subsidy at a very large scale, designed to directly get companies to come and invest. Now, along with that, the state took up the mantle of boosting growth itself and of course employment. And this was government capex, especially after COVID. Indeed, the government spending has been primary engine of investment growth since FY 2022. One assumption was that now that the government has stepped forward with unprecedented spending, private capex will follow. But again, it did not. Stripped of PLI subsidies, 806 applications, and investment of 1.7 lakh crore, private capex remained subdued. Overall, the government expenditure averaged 4.1% of GDP over FY 22 to 25, up from 2.8%. It's a big jump, while private sector's investments remained at around 2% of GDP. It may be higher this year, but no one expects it to sustain for several years at a stretch, given trade troubles. Private participation in total gross fixed capital formation (GCFC) fell to a low of 34.4% in FY 2024 from peaks above 40% in pre 2016. Of course, the peaks of 2006, pre 2016 were nothing great because those were years of crony capitalism crony lending, and scandal ridden projects. Even so, after four major interventions, bank cleanups, tax cuts, PLI subsidies, and state led massive investments, private investment remains underwhelming. In FY25, capital expenditure will account for 23% of total government spending, reaching levels seen way back in FY20 2004. Back then, India experienced one of its strongest private investment cycles. How did that happen? And why are things so subdued this time? For the past 15 years or more, I have watched economists at major brokerage houses wistfully predicting another private capex boom like 2004 to 2007 period. They would have been right only if the same factors were present now, which is unprecedented global and local boom of that period. In those years, both the two main engines of global growth at that time, which is US and Europe, were firing together. Pent up demand after years of recession caused by dot-com crash and 9/11 attack on the US was supported by low-cost exports at a massive scale from China and a tidal wave of global savings, mainly from Asia. It is the Asian tigers who made the most of the demand boom, being highly export competitive. Apart from its own share of exports, India benefited from the massive inflow of capital from foreign investors pumping money not only into the stock markets but for the first time into real estate. The 2004 to 2007 capex and consumption boom was not due to some deft and clever and far sighted policymaking, nor was it due to entrepreneurship. It was a happy accident of global excess. When the global financial crisis struck in 2008, the tide went out. So, factually speaking, India has never had a genuine, large, productive private expenditure cycle for any length of the time, which is purely organic. That is, which is funded organically, meeting a large rising demand. How to fix all this? Policymakers continue to treat private investment as a supply side puzzle to be solved with cheaper credit capital, fiscal sobs, or government led crowding in. The real constraint, however, lies on the demand side. Entrepreneurs invest when they see customers. India's domestic demand remains weak because consumption is weak, since real wages of the vast majority of people are not increasing. External demand offers no relief either, and in any case, India is not competitive at all in the export market, and that global trade winds are unfavorable. I was publicly skeptical of government capex to spur growth. More than 2 years ago, I had written that the heavy hand of the state has rolled the dice of growth. Let's hope we get lucky with what the dice comes up with. Luck, alas, is no policy. India's investment problem will not be solved until policy turns its gaze from the balance sheets of corporations to the income of its middle class citizens. Thanks for watching, and please do share.